Ladies and gentlemen, welcome to the Midday Market Monitor. Now, in today's video, we have some pretty interesting price action. For example, we ended up seeing Coinbase show off their earnings yesterday, which were not quite up to what people were expecting to see. However, the stock is up 17%. 17. Now, if we actually end up scrolling back just 1 month, we're still down 35%. So it literally is that meme where, it's falling into absolutely new pricing, then a small tick up, and then everyone goes, let's go. 17% up. Now, here's the thing. I'm extremely interested in Coinbase. Coinbase is one of those names where when crypto's on, this will be one of the best names. Okay. Very, very interested in that. However, knowing when crypto is going to turn around, completely different story. I don't think that it's very easy to call for a bottom on things like Bitcoin, still under 70,000, Ethereum, well, actually above 2,000 now, up 5.5% on the day. But trying to follow this will give you a massive headache. Ethereum will, right? And unlike names like BMNR that obviously can make profits over time through staking and these sort of things, but they're essentially like a fund, right? They want to invest in different ventures, whether that's Aiko Holdings or Ethereum, Mr. Beast, all of these different things, a little bit of Bitcoin action there as well. Coinbase is going to benefit off of the price increases of Ethereum and Bitcoin, but should essentially make money over time through subscriptions, service revenue, payments, loans, all of these things that are the rails are built on cryptocurrency, but don't actually have much to do with the real price action. So that diversification there and some of the things that Brian ended up talking about on the call about how they are, by far now the largest crypto player and growing internationally as well is quite exciting. So it's a name that I'm going to keep an eye on, especially at these, much better prices. Even being up 17%, this company's market cap at 43 billion is, practically cut in half from where we were not too long ago. Like you can go back essentially 3 months ago where this stock was at $300 a share. And actually, how high did it get? 402 back in October. Now at 165 and on a 17% up day. Like earlier this morning, it was 146. We had in after hours markets, algos actually ended up bringing the stock down to 134. I'm telling you guys, I don't know when it's going to be, but there's going to be an entry price for Coinbase that I am going to jump on. Because I like Brian Armstrong. I like crypto. Obviously, crypto pricing can be quite, it can give you a big headache. But the more and more that they, rotate into subscription and service revenue, the better it is going to be, right? They handle some of the largest, globally systemic important banks, many financial institutions. They hold a large percentage of, I think it's something like they custody something like 12% of all crypto. It's like crazy how big they are. But how's everybody doing? Why is Nvidia down? There were a couple things. So one, Nvidia models that they said that they had trained on Cerebras, which was a competitor to Nvidia. There was some Arista comments around AMD growing in market share. There was a ton of these different comments. I don't think that over time, especially in any multi-trillion-dollar industry, let alone multi-billion-dollar industry, that essentially every single country and large company is going after one market, that can actually be sustained by one individual player. Okay. So the fears that there are market share gains from other competitors is actually not something that I'm, even relatively concerned about for Nvidia. The thing that I care about for Nvidia is that they continue to grow at a healthy rate themselves, and knowing that the entire market cannot be served by one player. And in fact, the market share gains and how much they've been able to hold up this far has already been above my expectations. So there's a little bit of shaky hands there, but even then, like, we're still holding up a pretty good rate, 184 comparatively to where we were. Even if you go back a month, like we've seen some pretty aggressive pricing on Nvidia, bringing it roughly around 170. Okay, well, every single day they make hundreds of millions of dollars. That said, hopefully you guys are doing well, and yeah. You guys always ask me if YouTube is my main job. Yes, yes, yes. Investing and doing YouTube are my two favorite things to do on earth. And honestly, guys, you know what I've realized as well is that, well, actually, maybe I shouldn't give that advice, but it's benefited me so much to take the jump and do what I actually like, and it's extremely rewarding. So not just financially, I mean, just like how much I enjoy actually getting up every day. How much do you make a month on YouTube? Just curious. How much do you make, Wi-Fi? Okay. Do you guys know the 10 crack commandments from from Notorious B.I.G.? And then they say, you know what? Never let them know how much dough you hold. So you guys could take guesses. I'm glad that you guys like that one. Rivian up 27% today. 27%. Unreal. Who's buying these Rivian R1s? Whenever that comes out, are we buyers? I'm surprised that this is up so much, considering we actually saw multiple reports today talking about just how truly decimated the EV market is actually getting. And I think that it was pretty easy to call, to be honest. You know, like, we had an incentive where the price of these vehicles. Oh, sorry, R2. Sorry. You're right. R2. The R1s are the main ones that are already being sold at higher end pricing. But yeah, it turns out whenever the government actually subsidizes a percentage of your purchase price, that's an incentive. And that whenever that incentive gets taken away, people are like, you know what, the price of gas is actually not that bad. Yeah. Who knows? I can't imagine the EV market under the Trump administration is a place that I would like to be in. You know, obviously cybercabs, Optimus, like, there's so many other reasons to believe in a name like Tesla, but specifically in electric vehicle manufacturer, even if they're doing software and hardware stuff for other manufacturers, it's still all mainly in the EV space, and I don't care to play in that realm at all. Tanner, how are you smiling when stocks are down? Because I know that in the long term, I'm still betting on companies that are taking market share. That this is short term, and while the market, this is actually another report that was posted today. While the market is heavily leaning into things like options volume, I'm not. So essentially, I'm going to have more shares of companies that I like over the long term. And so I actually feel like I'm in a better position than I was previously. You know, I wish I obviously had more cash and timed the market better than I did, but timing the market has never been my forte. I could have told you that, 9 years ago, the first crack at it that I had, that I'm not very good at timing the markets. But if I were to lean into my strengths, it would be just, hey, you know what? I feel like I know certain technologies to be fads and certain technologies to be absolutely real. And as long as I bet, thematically in those areas, honestly, you don't even have to get your timing all that right to be extremely successful. So I'm betting in fintech. I'm betting in artificial intelligence. I'm betting in all those things that are essentially going more digital and allowing companies to save on margin and compete on price and offer users better products. And eventually, I will be rewarded. Yeah, I mean, hindsight's 2020, but you know, I don't care to do that. Year-end price target for SoFi? You didn't hear a word I said. I've got no clue, brother. I hope for way higher prices than where we are today. But like it's so interest rate sensitive that if we don't end up seeing two rate cut, like if something changes, um, bad jobs data, labor market suffers, like anything like this could end up throwing off a company like SoFi super far. You're asking me to Tom Lee myself, and I will not have it. Okay. I don't know. The same way that Tom Lee doesn't know, but he won't admit it. and if you guys think Tom Lee knows, he doesn't. He's been wrong countless times this year. It doesn't mean that he's not more right than wrong, but this recent track record is bad. Okay. Tanner Lee Manson. That's not even bad. I like that. But look at this. Fastly, by the way, up another 12.6%. They're up 110% in the last 5 days. That's crazy. That's crazy. Wealthfront. This is the company that we looked into, almost like a first impressions, if you can even call that, on our first live stream today. Dude, this is an interesting name. I'm not buying it because I think it's going against all the things that I've been wanting to do during this period. So I want to buy companies that I already like and already know. Whenever you're exploring new names, there's just room for you to miss so much detail. There's stuff like lockup periods and stuff like this for Wealthfront that are also concerning. But this is a $1.2 billion company, even up 11%. Yesterday, it looked a lot better. I mean, this company at close at $7.20, for real, was an insane price. But they're extremely profitable. If you guys don't know Wealthfront, they essentially set up like robo-advisory, cash management. They're just starting to get into mortgages. Every single fintech is essentially going in the same direction where they want to be a super app. It's just, what's your unique aspect to get into that market? Wealthfront was robo-advisory. So Wealthfront, like I said, extremely profitable, 33% net income margins, high free cash flows. Like, they have no corporate debt, $266 million of cash, and the company is priced at $1.2 billion after IPOing like a month ago. December 12th, 2 months ago, they IPO'd and ran up to a price of $14.88. Today, it's under $8. That's crazy. Talk about an acquisition target for a SoFi or something like this. I mean, you're getting like 1.4 million high earning income individuals for an after cash price of $1 billion. Crazy. It would be highly accretive to the bottom line. It would be, who knows? Maybe they don't want to do that though, because they just feel like they can compete and win. Like Wealthfront, although they're growing, is not growing nearly as fast as a SoFi or a Robinhood. And then all those companies are trying to get into this space. Robinhood Strategies, SoFi Robo-Advisory, like they're all essentially tackling this company's moat. If you you actually can't say that they have a moat at all. There's going to be a lot of consolidation in the fintech names. This just might be one of them. Honestly, Wealthfront and Chime should merge. What Chime doesn't have, well, I mean, maybe not. Maybe like, I just thought of that now. Maybe that's not even true. Because they're more high income earners and Chime's more lower end. But yeah. Robinhood Ventures, I guess, is doing a Robinhood Ventures Fund roadshow starts in 4 days. You get early access to an upcoming live stream of Vlad Tenev to talk with the RVI Roadshow February 17th at 1 p.m. Eastern Standard Time. Are we getting into private markets? I was talking with this VC recently, and he essentially just said, like, every single big bank and institution is rushing to give retail access to private markets. And once again, you see Anthony Noto just a little step ahead of everyone. Like, it's actually quite cool. Like, whenever you look at it, I'm not even saying execution-wise, but the products that they did end up going for, they were the first company to essentially do something along the lines of a SoFi Plus, a fractional. They pioneered fractional shares. They did, they were sort of the first people to say that they wanted to go after a financial super app. They got into private markets before anyone else through Templum and a lot of these companies. And like, it's pretty cool, actually, how forward-looking Anthony Noto has been. Pretty interesting. Okay. But like I said, for Wealthfront, I'm not actually buying it. It's just always nice to explore a new name. I'm actually probably closer to buying into a Coinbase. Like I said, I want market leaders here. Or honestly, just doubling down on the names that I already have. Hood, SoFi. Although these companies are catching a bid today, they're still historically cheaper than where we were in recent history. At least comparatively to how much growth that we've just put up. Coin versus Hood is the question. I mean, I think it depends on how much of a believer you are in cryptocurrency. If you have a high belief in cryptocurrency, Coinbase is going to be, more rewarded in that space, just because the diversification of their revenue is more focused on crypto. But if you like the diversification of just like, hey, you know what? I'm just a believer that retail investing is going to continue to keep up. Maybe Hood is a much better buy there. There was why didn't I save it to my thing? There was a massive report on options trading volume. Here it is. This is going to serve well for names like Robinhood. Risk appetite has arguably never been stronger. The 10-day average of notional options volume on the S&P 500 stocks is now up to $530 billion, the highest in at least 2 years. Look at this, guys. Oh, my. This measures the total dollar value of options contracts traded on individual S&P 500 stocks, reflecting the amount of money flowing into single stock bets. Robinhood, they're taking all of that in for their February numbers. And it actually looks like it almost bottomed a little bit in January. So I'm curious how the January numbers are going to reflect versus February, where we end up seeing this massive spike, and if they can actually hold up this increase. Do you think Robinhood and SoFi should merge? It's not really about what I think I would like. Are they going to? No, they're not going to at all. I think that Vlad's going to do his own thing for an extremely long period of time. Tanner, would you buy Google or Meta at these prices? Well, I would buy both. If you're asking me to pick, I think I like Meta more, just because I think they're both going to do extremely well, but Meta has quite the discount on it right now, comparatively. $650 on Meta, expected to grow at 30+% rates. I mean, that is exciting. And also what I would essentially say is pretty AI proof. I think Google is too. They're going to be a massive beneficiary. They both will. And they're both going to spend so much to get there. But yeah. Okay, let's have a listen to There were a couple really interesting videos that ended up happening today. Airbnb's CEO Brian Chesky ended up speaking about how AI is going to be the best thing that's ever happened to Airbnb. I thought that that was pretty interesting. If you guys don't know, I was a shareholder, at least for the longest time, and it was not a great return, but I love Brian Chesky with all my heart. I think he's one of the greatest CEO. Like, I think that he just gets it. Okay. That being said, I think that they've made some moves and have been slower, in adopting and being more aggressive, and also the macro has not been great for Airbnb. So they've suffered at times, but Brian Chesky, in terms of like his focus on the future, I actually think is very clear. And the fact that he believes that AI is going to be so legit is like I much want to focus on, because I don't think that Airbnb is the only company that's going to benefit. There's like a million companies. Okay, let's go ahead and have a listen to this, and then we can get in the next video. Actually, let me just rotate this up to here. Put it on a different monitor.
Airbnb shares are taking off after the company beat on Q4 revenue and posted solid earnings guidance for 2026, though it did miss earnings estimates. Our Sarah Eisen spoke last night with Airbnb CEO and co-founder Brian Chesky in an exclusive interview.
We outperformed our forecast. We believe that nearly all of the outperformance was from innovations. It's always hard to attribute exactly, but we think that the vast majority of the outperformance is from innovations. And that's why we're able to, for the first time, put out annual guidance. And we have, pretty aggressive outlook for Q1, is because we are feeling a little bit more confident about the momentum of the company increasing through our sustained innovations.
Yeah, you say that you expect to grow revenue at low double digits. I think you say at least low double digits.
At least.
So what is giving you that confidence? What are you seeing as far as the changes?
I mean, again, I think what we're seeing is this momentum around innovation. So, right, like we have all these different like flywheels that can accelerate the business. So with international expansion, for example, 70% of our business is in 5 countries. A couple of years ago, we put a team on Brazil and really focused on that market. It went from one of our top 10 market to a top 5 market. We're now putting that same focused effort in Asia, other parts of Latin America, and Europe. So that's one of the reasons we're having excitement. The other are new businesses, services, experience, hotels. We're piloting over 6 new offerings this summer. We think these are going to really bring a lot more people to Airbnb. We're getting a lot more momentum around, customer service. AI-powered customer service is handling 1/3 of our tickets in North America. This is making people more satisfied with the service. People like the quality. So it's really just this giant flywheel. You can think of Airbnb as like a marketplace, and you have to crank the flywheel. The faster you crank it, the faster it grows. And we're really, I think, starting to get momentum.
What about the AI story? I'm just looking at the stock. It's down 13% into earnings this year, and more than that over the last 12 months. The market has been obsessed with the winners and losers from AI, who's going to be disrupted, and how AI is going to change all sorts of businesses. What's your story here?
From a business standpoint, I think AI is the best thing that ever happened to Airbnb, at least from a technology shift. The reason why is AI solves so many problems. Number one, the traffic we get from chatbots converts higher than the traffic we get from search engines. Most of our business is not the app that a guest uses. It's the host app, it's the customer service, it's the payments, it's managing 5 million hosts and all the activity that happens on our platform and all the new businesses that we put together. AI really can improve search in Airbnb. It can improve customer service. So fundamentally, I think the first point is we're not like a software like layer that AI can potentially do more efficiently. Most of Airbnb's business is in the real world, and we think Airbnb AI is a tailwind. The second thing is a cultural thing, though. I think the founder-led companies and the companies that are prepared to change and transform are the companies that are going to benefit from AI, because AI means everyone changes. And if you don't change, you're going to be disrupted. So if you don't disrupt yourself, someone else will. And we're not going to allow people to disrupt ourselves. We're going to disrupt ourselves first. And that's why I hired Ahmed Al-Dali. He was the head of generative AI at Meta. He was the person who led all the Llama models. He had a long career at Apple before that. And he came here, and this was a really big partnership that he and I have to really make sure Airbnb is on the frontier of companies leaning into AI.
Is there a metric that investors can track in 2026 where everybody's hungry to see the return on investment and the receipts for what AI is delivering to track this transformation?
Yeah, just our revenue. You just need to look at our revenue. I mean, our goal is that we're going to have consistent margins, and we're going to try to continue to accelerate our revenue growth.
All you guys saying he has a fake background. I mean, his company is literally like a real estate company that makes model homes and exciting experiences for people, and you don't expect him to have a cool background. The comments, the Brian Chesky hate in chat, it will not be had. Okay, he's an absolute legend, and I'm not listening to you guys. Okay, that being said, I think that B Up is very right in this comment, and I completely agree with you. This kind of talk is what most company leaders are saying. So why does the market not listen to them and instead listen to some random bearish analyst that really does not have an understanding of what's going on? Completely agree. I'm listening to the actual CEOs, and they're all saying how exciting things are, how the margins are going to inflect, how the companies are going to be able to move much faster, and revenue growth is going to couple on, and all of this stuff. But yet people are like, oh, let's go hear what this random person that's never started a business and instead manages money has to say about how to run Airbnb. Okay. Let's see. Tanner even hired a cat actor acting like his own cat and dog too. Yeah. Okay. Let's go ahead and have a listen to some of those potential analysts that are worried that the economy is a little bit weaker than maybe Brian Chesky is leading on. Let's have a listen.
Joining us today is Mark Zandi, Chief Economist over at Moody's, and Jim Paulson, former Chief Investment Strategist at Leuthold Group and author of Paulson Perspectives, a great read, as always, on Substack. Morning, guys.
Good morning.
Good morning.
Mark, I know you said you wouldn't take a lot of solace in this week's jobs number, but can you take solace in CPI?
Yeah, I mean, inflation is still on the high side. I mean, Carl, as you know, the inflation numbers are biased lower because of what happened last October when the government shut down. The BLS couldn't collect that data, and they assumed effectively no inflation. So if you account for that, CPI inflation year over year is closer to 3%, not 2%. So it's still on the high side, and it's still high for necessities, things that people need: housing, childcare, medical care, that kind of stuff. So it's still on the high side, but it's not moving higher. I'll take that. So there is some solace there in that. Yeah, I guess so.
Right. Jim, how about you?
I think the economy overall is weaker than widely anticipated here. I think Mark shares that view. And I personally don't think inflation's an issue. I think inflation, we had a brief COVID-related supply distorted bursts of inflation, but it's come down basically below 3% ever since. And the obsession with 2% seems kind of ridiculous to me. I think it's kind of benign and will get weaker, I think, because economic growth is weak. So I think there's plenty of room here, both from, if you look at the job market, barely growing, you look at the housing industry being a mess, real retail sales been flat for years. Now inflation coming off, true inflation has just collapsed here recently. So I think there's a lot of room for easing to possibilities.
Yeah. Stay with us, guys. We do have some news alert on tariffs, and for that, we'll turn to Steve Leisman this morning. Hey, Steve.
Just got off the phone with Peter Navarro, special counsel to the president on trade and manufacturing. He says there's no basis, in fact, for a story out in the FT that said the administration is planning to reduce steel and aluminum tariffs. Navarro telling me the president has a rule, no exemptions, no exclusions. He went on to say steel and aluminum are sacred to this administration. He thinks stories like this are not helpful to the administration's efforts to try to get investment in steel, aluminum in this country. The FT reporting, citing 3 unnamed sources that the administration was planning to scale back those steel and aluminum tariffs after complaints, which I've heard, by the way, also from a lot of manufacturers and importers, that they have to pay up to a 50% tariff on steel, aluminum, and the FT reporting that the administration was feeling the heat of these consumer prices that had gone up as a result. But Navarro saying no plans by the administration to scale those tariffs back. Carl.
Yeah, Steve, it's a little bit of a sharper retort than Bessent with Joe this morning on Squawk, who said, we'll see if there is a narrowing, and arguing he didn't want to get ahead of the president.
Yeah, good point. I forgot to point out that Bessent did kind of throw some cold water, but this is a bucket full of cold water on that plan, unless there is another part of the administration where there's some angling to reduce these tariffs. There is a lot of complaining going on. I know, for example, just not to make fun of this, Carl, but for example, if you are importing a fishing reel, you will pay a tariff on the fishing reel itself and then an additional tariff on the percentage of that fishing reel that is steel and that or aluminum. And that has really confounded a lot of manufacturers, not just obviously in the recreational industry, but in a lot of other industries. And another point in that FT article, which is a story that we've been on quite a bit, is the complexity of these tariffs. Scott Lincecum from Cato writing a landmark story on just how complicated it is. And the FT quoting one manufacturer or one person in the article saying that 4 different crates got 4 different numbers on the tariff. So at the very least, if not for scaling them back, there is a tremendous argument made for reducing the complexity of these tariffs.
Yeah, simplification, Steve, would certainly help. I know a lot of the customs consultants have been very, very busy. It is a boon for their business, I guess, if nothing else. Steve, this is really good stuff. Thank you so much. I would like to turn back to the panel. Mark, I mean, obviously, now it sounds like we have a little bit of cold water this morning, a bucket full, as Steve puts it now, from Peter Navarro on the idea of reducing steel and aluminum tariffs. What do you make of this?
Well, I'm not a fan of broad-based tariffs. I mean, I think we talk about inflation. CPI inflation is close to 3%. I'd say without the tariffs and throw in the heavy-handed immigration policy, we'd already be back to the Fed's target of closer to 2. So I think the tariffs are a problem in terms of inflation and in terms of growth. I mean, go back to the job market. There has been effectively no job creation, none, since Liberation Day back in April. So anything that would reduce those tariffs, I'm all for. I think that would be good for growth and for inflation, make life a lot easier for the Federal Reserve and the typical American household.
Jim, you're talking about how in your notes you think that the economy is probably weaker than many appreciate. Do you think the Fed feels that same way as we sit in this pause situation with rates?
I don't know, Courtney. I think it's a great question. I mean, last meeting, Fed Chairman Powell said the labor market seemed to be stabilizing. And, you know, we've got job creation, as Mark said, that's basically flatlined for the last year. You know, the average unemployed duration in this country is almost close to a half a year right now. So if you lose your job, you can't get one again for a long time. It's just, to me, having no jobs is just unacceptable in American capitalism. It means no prospects for Americans. And I don't think that can stand. And I think the Fed will be forced to ease. But, you know, we are fortunately getting some easing already. Money supply's picked up. The dollar's come off. The yield curve has been steepening. You know, I think we need fiscal juice too. The deficit to GDP has contracted from about over 7% a year ago to 5%. So I think there's a lot of room for easing potential, and I think that's going to be big for what's going on in the stock market as we shift from new era to kind of old era stocks taking the lead.
Jim, I mean, I imagine that a case like that would be countered in the room, perhaps in the Fed or elsewhere, by folks saying, look, labor force participation among prime age Americans is pretty much back to a 25-year high. We have 6% fiscal deficits, or getting back to that around this year. And by the way, the stock market and credit spreads are very tight. The stock market has been trying to maneuver to play a potential pickup in economic growth with cyclical leadership. Maybe that's faltered recently, but that's been the trade for a while. So what are your answers to those?
Well, I agree that easing has been helping. We have had easing, and I think that's why we're seeing new leadership take over among small caps, value stocks, cyclical sectors, international stocks. They're tied to a lower dollar, faster money growth, steeper curve. I think that's helping that. And I do think they're anticipating a pickup in the second half. But I think that where we are, I think if you back out trade year to date or over the last 4 quarters, Mike, you got real GDP growth, which is at 1.8%. If you back out net exports, if you take personal consumption and investment spending together, they're growing just barely over 2%. That used to be the stall speed for the economy. The unemployment rate's already been rising for 2 years. I think I just don't know why we stand pat when the conditions of America jobs are this bad. I'd rather risk an inflation problem, which I don't think we have, than the other way around. And I think that's going to ultimately be the choice.
Yeah, I mean, I'm not even, I don't know, anti that. I think that there's going to be some very weird changes with the labor market because of artificial intelligence, which I do wonder how they're going to end up dealing with that in terms of just like, hey, do we just keep cutting rates and, go back to like a ZERP environment and try to allow for more job growth, even in a world where we have AI agents and autonomous robots and full self-driving and all of this stuff? There's going to be a weird transition period, but in my opinion, bet on tech names, baby. Okay. Yeah, I mean, there could be other things, immigration stuff that's also changing. I know that that's been a big factor as well. I remain very optimistic overall. Okay, let's jump into some more of the news here. There was actually a not Tesla report, I shouldn't say that, a SpaceX report where Musk is trying to get sort of a dual class IPO, meaning that they're going to still have probably their Class A common shares and then more of a founder class share for Elon Musk so that he can retain his power in the company regardless of any level of dilution, or if he ends up selling shares to raise capital or something like this, that he still has the final vote of the company to say, hey, what direction we're actually going and what moves to make. Shopify's done a very similar thing. Facebook, there's many companies that have this form. But weirdly enough, it looked like Tesla, after that news, ended up reporting that they saw some pretty interesting price action. Let's go ahead and have a look at the overall markets, just see what's moving, what's not, what's hot, who's not, and we'll go from there. QQQs up 0.7%. Cool. SPY. This is the general S&P 500, also having a nice green day. Broad market green, slight little rally here today. But doesn't mean much in terms of the long-term scheme of things. I mean, things can change. Gold up 2.4%. Is silver also rallying up 3.8% on the day? Very exciting. Do we have any gold and silver bugs in the chat? Or are we all into crypto, which is having a good day, but still below 70,000 on Bitcoin, and Ethereum, I think, was over 2,000. Yeah, 5.8%. Still doing very well today. Can it hold up? Who knows? Silver is my meme coin. Copper. Physical gold and silver. All right. We talked about why Nvidia is slightly down, maybe some nervousness on market share. OpenAI ended up talking about training models on Cerebras, and I think it was Arista Networks that was talking about AMD gaining share as well. So that might be interesting for AMD. Let's see where they are today, up 1.2%, which definitely does show that, there is some benefits to AMD that today, more confidence in AMD than Nvidia. Now, does that actually mean that it's true? We'll have to see. But it does make me still like, I don't know. Could I end up betting on AMD here at 208? Like, that does seem pretty interesting. The build out is still absolutely happening. By the way, Nebius, let's take a look at this. Earlier, whenever I checked, still having a very good day, up 8.5%. The market completely faded. How nice that their most recent quarter was. Probably one of the best quarters, if not the best quarter that they've actually had, not just in terms of higher numbers, but just like a lot of the confidence that they instilled in shareholders. So meaning, although they are spending a lot in CapEx, I don't know what else you would expect from a data center. Like they literally build out data center. I'm about to flip my desk. It's actually crazy that a data center specific business, that's all they do. Okay. They're creating the Nebius cloud and then they end up raising CapEx and people are like, that's bearish. It's like, what? That's that's their business. Like they're seeing a lot of demand. You know? It's crazy. They're trying to go out and build more data centers so that they can actually fulfill customer needs, which they are saying across the board is higher. And people are like, no, they're spending 16 to $20 billion. And you know what, guys? I hope it's 25. I hope it's 25 and we're all wrong. But at the end of the day, that would just lead to higher and higher revenue growth at better expected margins over time. And not like I can actually see how people could be more bearish on an Nvidia or something like this because you're like, okay, well that's just for right now. We're in a big build out phase. But what happens after the build out phase? Do the customers just all go and say, oh, you know what, we're going to start building back on-prem, or we're not going to end up going to the cloud anymore. All the training's done. I don't understand how this happens at all. Nebius did try to claim that they're going to fund CapEx from cash flows, which is highly unlikely. They're already, 60% is already being paid via the customers that are already giving them large contracts. And if you feel, by the way, backstop like CoreWeave or something like this is great, but I don't know why that's not believable. Like, do you think they're lying on their earnings call whenever they say that they're getting a lot of upfront payments and that they're essentially saying in their terms and in their deals with Microsoft, like, hey, you guys have to directly help us pay for these GPU buildouts, that they're lying? Okay. So what is the price of Nvidia without all the stock splits? What? Honestly, if stock splits and share prices are bothering you, just look at the market cap. That won't change for anything. So 4.5 trillion is roughly what the company is worth. Erwin, good to see you, brother. Great to see you. Okay, let's see what else is moving. Pinterest down 17.6%, but actually having a decent day, at one point being $13.84, now starting to recover intraday, I should say. Not that they're having a good day in the last 24 hours. They're down 17.6%. But let's go ahead and see what they had to report on earnings. I didn't see the Pinterest update. The only one that I really paid attention to yesterday was Coinbase. And honestly, I thought it was a good call. I think that they highlighted or needed to highlight that like the crypto total market cap and total volume is down for them. So it's hard for them to win during those moments. But what you needed to see was market share gains. And they proved that, who uses Pinterest still? Genuinely asking. Let's see how many users they have. Maybe it's on Fiscal AI. How many users? Total active users monthly, 356 million. Sorry, global monthly users, 619 million. My bad. Oh my gosh. $10 billion company. Yeah, that's crazy. I don't know if that's to be. I'm just reading what Pinterest says right here, or sorry, what Fiscal AI says right here. 619, still growing at about roughly 12%. Pretty interesting, but I don't care about this business. Why buy risk on Nebius when Amazon is a guaranteed winner? Just like any company, right? So while I do think that Amazon Web Services is going to be a guaranteed winner, and honestly, I think Amazon's going to be a guaranteed winner. It's that there's so many things that are diluting them. So you could even say, hey, I mean, there's a possibility that Amazon loses, but the guaranteed winner is the S&P 500. So I should just buy the S&P 500. Or, you know, there's not a guarantee that the S&P 500 wins, but maybe there's a guarantee that if I have a balanced portfolio with fixed income products in it, then I will have a guaranteed win. Or if I buy American T-bills, that's a guaranteed win versus equities that could have volatility. Why don't we just strip out the volatility altogether? See where I'm going? The risk to reward ends up changing drastically. It's not just about what the risk is, it's also about the reward. So Amazon's, you know, total revenue growth, and this is only revenue. So we're stripping away a lot here, but their total revenue growth was 12.3%. Okay, which is actually quite good. There's two main businesses that are high margin and growing that I honestly think like you could distill down Amazon to being like, okay, focus on these. Like Amazon.com, online stores, physical stores, they're going to do fine. But like actually what you really should focus on, let me pull this down for a sec. What you should really focus on is advertising revenue and AWS as being like extremely fast growing, high margin businesses that are growing at 23 and yeah, they're both growing at 23%, roughly. Okay. Now, AWS, there's a potential that they could end up bringing this growth into the 30+ percentages, and that's why the market can be excited about that. And so, yeah, maybe that's a guaranteed win. But whenever you look at, okay, how much is AWS in revenue at 35 billion versus the total amount of revenue at, you know, 719 billion or whatever it was for the full year, 213 billion for the quarter. And what's the percentage of overall operating income? AWS maybe, what is that, half of all the operating income? So you have half the business being dilutive into other industries. So Nebius is a full play cloud infrastructure name. If you believe in AWS, why don't we strip away all the open or the online stores, the physical stores, the advertising, and just go for what we actually want, which is the cloud part of the business. Yeah, it's riskier. You have to learn new management. Execution's a big factor. The amount of capital that they actually have, big factor. But you're getting exactly what you want. And so the growth there, by the way, on Nebius, 550% year-over-year growth, not 23%. Not 12%, 550%. So it's not a guaranteed win, but the upside is way higher if they get it right. Let's see. Tanner, respond to Grundle something. I see his one comment. Did you comment another comment? How can I respond to AWS for sure? Was there another comment? Outfit inspiration. Oh, what do you want me to answer to this? Okay. If the S&P has a correction, tech falls further, or everything else while tech is flat? I mean, I'm sure that tech would fall with it, but maybe disproportionately, like less, just because it already is so sold off. I mean, companies that have no debt and large growth rates, usually find it very hard to go bankrupt. Okay. Rather have Mercado Libre than Amazon? Yeah, but then you don't have AWS. Then you're really focused on the e-commerce and logistics side and the fintech side. But what are the two things that separate those businesses? So, and I hold both of these, but Mercado Libre has a fintech that Amazon does not. But Amazon has the largest data center company in the world or cloud business that Mercado Libre does not. Okay. What's your go-to running shoes? Right now I'm using Hoka's. It's completely wintertime for me. So I really like trail runs, but it's in the winter. So I need to get like a good shoe for both of that, or for both of those things. And right now that's Hoka, which is also great. Like back in the day, it was Nike or Adidas. And the fact that there's so many other players now, it's like the whole thing has changed. Where in Canada are you? Toronto. I just ordered a Whoop. Brother. Sick. Love it. Which Hoka? I'm not sure. I could go get them. Yeah, I'm actually not sure. Check out the gold miners. No. Tanner, I think it's time for big oil and mining. The tech bubble is bursting, all this money and no real AI progress. That's crazy, dude. You have not been keeping up with any of the market. You know what's crazy is I still have conversations with people whenever I say, like, I'm buying into AI companies, and they're like, oh man, it's hallucinating. Like, you can't get anything done. I was like, have you guys used this? Like, the technology is changing so fast that, like, even comments like that where it's like, oh, it can't do anything useful. It's like, okay, well, you haven't seen it in the last month. Oh, it's hallucinating. It's like, okay, well, you're like 6 months behind. Like, can't do math. Okay, well, you're 2 years behind. Like, it's crazy how much the AI market has changed. And you can see sort of when people have looked at it last. I'm not even really talking about you guys, but like whenever I have to talk to relatives and stuff like this about like artificial intelligence. OpenClaw is wild. OpenClaw is wild. However, I actually got extremely what's really funny is the real use cases out of OpenClaw that I'm seeing are actually super what you would expect. Obviously, there's people that are like showing extreme use cases, but then it's usually actually just putting out slop and not useful at all. I think like the real use cases for OpenClaw and what we're going to see out of agents is like email management, daily tasks, like all the things that like Zapier would have been able to do at extremely high costs. Using tools to help, but this whole idea that like OpenClaw is just going to rework entirely how humans interact and stuff like this, I think is not actually what we're going to see. There's already been studies that have been reported that AI agents are used best whenever it's sort of like a 70-30 split between, like humans still need to be the supervisor of these models. And I think that's super cool. Rather than this world that people want to make you think that what is happening is like, oh, we're setting up 100 Mac minis and this thing's going to make businesses on its own and deliver products on its own. Yeah, I get the for now thing, fully aware, but honestly, like, I do think humans do have a space. And maybe I'm overly optimistic, but I think that the agents are going to cut out all the crap that we don't want to do, and there's going to be stuff that we will want to do, and AI agents are not going to play a part in that. It's like having a personal assistant. Yeah, I think it's going to be having like 1,000 personal assistants. But that's awesome. How long have you held Mercado Libre? I think my average cost on Mercado Libre is right around $1,200. Tanner, I think you need to do a poll if you should add Vertiv to your port. I'll pound the table until it gets to 500 billion. Well, dude, the port the poll could say 99.5%. It doesn't mean I'm going to buy it. You know, it's going in the community portfolio, but to be honest, I mean, I'm not buying based on consensus. You guys could all say it. I don't give a crap. Same thing with Zeta. It's like the whole world's telling me, like, I need to buy this company or else I'm not part of the YouTube community. No, it's my portfolio and I can have it the way I want. But yeah, I'm not anti-Vertiv. I just haven't looked at it. You did great for not buying Zeta. I don't even think that's true. I mean, all the companies I'm holding are down too. It's like watching the entire industry down and then saying, "Oh, thank God I dodged those bullets." It's like, I mean, the ones that I have are down. AI is ubiquitous. Many benefits. Wait, where did that go? Many benefits are hard to measure, not to mention that we are still building the infrastructure and developing the models. It's very early. Infrastructure build out must finish first. Yeah. I'm well up on the air. Everyone give James Smith a round of applause. Golf clap. That's awesome, man. I like, yeah, for the people who had cash, like, you guys were very well positioned. Nvidia has Nvidia Direct bearish information that's coming out. Dude, I want Grab. What's Grab at? $4. Damn. Okay. Guys, everything's down. Everything is down. I wouldn't be picking on individual names. Sorry, not everything's down, but everything in this space, in the tech space that we cover, like, a lot of those names are getting hurt. Do I follow any ETFs? No. Not unless there's some of the big ones. Caterpillar isn't down. Yeah, I'm not following Caterpillar, but yeah. And Caterpillar actually is a name that, like, I wouldn't even mind having in my portfolio. Like, I think that fits. But there's some names where people are like, man, you need to get into, like, tobacco and alcohol and beverage names and stuff like this. I'm like, dude, for real, no. Like, because then whenever things return and I'm stuck holding on to these value names that I can't even Like, for real? Okay. I love investing in companies that I believe in where the future is going. If I start buying into like gold miners and trying to be thematic that way and like short-term things, and then you get the timing wrong, you know how bad you'll feel about yourself? You'll be like, man, why did I, like, this was I was holding on to all the great, I was holding on to Amazon and Meta and Nvidia and all of these great companies, but I tried to be smooth with it. And I got into these companies that I thought were good for right now, but I got the timing wrong. It's crazy. Also, you guys want to see the biggest flex you've ever seen? This is like me showing you that I just got like $1 million dividend payment. Okay, you ready? 85% on my Whoop. Not great. Okay? Well, I mean, it's fine. That's not the brag. The sleep consistency, unreal terrible. All right? Hours versus needed, 94% with sleep efficiency at 96%. I'll tell you what that means. Last night, this is the hardest flex I've ever done in my entire life. Okay? Last night, I slept, not in bed. I'm not just talking about in bed. I was in bed for 9 hours and 23 minutes. I slept for 9 hours. Like asleep for 9 hours. Bro, come on. 25 minutes of that awake. I had like 2 hours and 40 minutes of REM sleep. Like, that might as well been of like, hey guys, I bottom ticked the market and now the market's recovering on Trump news. I love how some of you guys are saying that's bad for me. Go read a book. That's amazing for me. I feel great, and you're on 6 hours thinking that that's what's important in your life, and you were doomed from the start. Okay, that's amazing for me. I had sleep debt. Okay, I was getting up at 6 a.m. to go watch Nebius and all this stuff, so I was accumulating debts, and I've paid them off, baby. I'm debt free. Okay, and you don't know what that feels like because you got bills to pay and children to feed, and I'm over here living the single life. I'm not even single, but you know, I've got a nice king size mattress. My girlfriend rolling around doesn't even wake me up. I sleep through it all as if I don't have a dog in the room, even though I do. Okay, I'm on top of the world today. And then you guys are asking, how is he smiling whenever the market's red like this? And I'm saying, I slept for 9 hours. Like, come on. That's power. I've transcended. Okay. This body is merely just to hold my aura in. I'm ready to leave. I'm like, oh my gosh. Let's see what's new in the world. Back to work. I'll tell you why OpenAI, sorry, Nvidia is sinking. This was sort of the video as to what caused this little bit of a dip on a day like today to have Nvidia down. I just shared the exact same screen. I need to go back to bed. Okay, let's have a listen.
Its first model to run entirely on chips from the startup Cerebras. It's a sign of companies diversifying beyond Nvidia GPUs. Our Dur DeBosa has more on that in today's Tech Check. Morning, D.
Hey, good morning, Carl. So never mind that OpenAI is one of NVIDIA's largest customers. This is also part of a larger trend. Google shipped Gemini 3 in December, trained and served on its own custom AI chips, TPUs. Then you got Chinese AI lab Jipu releasing GLM trained on Huawei chips. And we know that others like Meta and Microsoft, they are diversifying, working and now shipping their own versions of AI chips, at least for themselves. Now, the move for OpenAI here is inference. And that may actually matter more financially because training is a one-time cost, but inference, actually running the model for millions of users, that is a recurring cost. And as these products scale, this is where the majority of compute dollars is supposed to go. Now, to be fair, this isn't OpenAI's most powerful model. This is GPT 5.3 Codex Spark. It is lighter and faster, but that is often what actually gets adopted. Flagship is the prestige play. Workhorse model is the revenue play. NVIDIA can continue to win the former, but it is ceding ground in the volume game. Now, OpenAI is being very careful here. Before this model, it was running everything on NVIDIA chips, or Ashley Kaput confirmed that. But now in a statement saying NVIDIA is still foundational while deliberately expanding the ecosystem around it. So it's a diplomatic way of saying we love Jensen, but we're dating other people. Now, there's also real friction here. Reuters reporting earlier this month that OpenAI is unsatisfied with some of NVIDIA's latest chips for inference. Now, this is a tension that's playing out across the entire industry right now. Every major AI lab, they still want Blackwell allocation. This is still the gold standard, but behind closed doors, nobody wants to be this dependent on a single supplier. So they're smiling at NVIDIA with one hand and signing deals with Cerebras, Broadcom, AMD with the other. The investor narrative, guys, it is shifting accordingly. Infrastructure money, those hundreds of billions, trillions of dollars, they will still get spent, but where it is spent will look different, and NVIDIA arguably the one with the most to lose here.
I mean, Deirdre, I can understand maybe if you're NVIDIA, you don't love this move. Maybe you want to be exclusive. But if you're anyone else, is it just a smart move to diversify, make sure that you have other partners that can help you run your business successfully?
Yeah, absolutely. It's one, supply and demand. NVIDIA can't make the highest end GPUs fast enough to satisfy everyone that wants them. So that's a nice problem to have. But that means that they also have pricing power, right? They've had a near monopoly sort of on this segment for years now. And we know how important these companies, at least in America, want to reach new frontier models. China also needs them. So they want to diversify, one, to get better deals, not just let NVIDIA continue to raise prices whenever they want, but also, yes, like actually serve the inference that they need. And that's why, even Anthropic is using Google TPUs. And you have Cerebras, and you have a number of other chip makers that are making a play, importantly, for that inference area, which seems easier than training because everyone still wants the Blackwells, the most advanced chips for that part.
Dee, meantime, I wonder if you think that the memory chip story got a little broader this week. It's not just about Dell and HP. It's crept into Apple, Cisco yesterday, fifth worst day in 25 years.
It's so fascinating, Carl. I know I talk a lot about sort of the Chinese competition, but here it's extremely relevant as well. There was a piece a few weeks ago about American companies actually wanting to buy Chinese memory chips. And we talk about the high end, the advanced chip market in China, how they're getting better and better. But at the lower end memory chips, China has improved enormously as well. And clearly there's a market for them, similar to this story, right? Both at the high end and the low end, there's sort of this chip scarcity, and the Chinese are doing a pretty good job at filling the gap.
Yeah. Dee, appreciate it. A lot of cross currents this morning in AI and memory and all the rest. That's Deirdre Bosa. Market's been actually adding to its gains throughout the course of the day.
All right. Well, that's enough there. I like how said better and better. It's better and better. Better Call Saul. Yeah. No, essentially, I do think that names like AMD will do well. Nvidia, I still think is going to do well, and everyone is sort of comparing their chips versus the older versions of Nvidia, and they're saying, hey, you know what, we don't want Nvidia to have all this pricing power. Well, guess what? The rumored talk about an individual NVL72 of Vera Rubin is expected to cost roughly a 95% increase versus their old Blackwell chips that were roughly about $3 million per system. Now these ones are looking to be about $5.7 million per system. So, yeah, I don't think the pricing power has gone away at all. And while you're trying to catch up with Nvidia, they're ready to launch their new system. And then on top of that, you're going to have Vera Rubin Ultra, Vera Feynman Ultra. And I'm sure at GTC, we're going to see what the next step after Vera Feynman might be. So who knows? I'm going to continue to hold. Yeah. Anyway, guys, I saw a bunch of comments on my sleep. First off, I'm fully aware I'm a loser. Okay, I get it. This is what makes me happy. I'm not saying that you guys have to copy it. The next comment I'll make is the people that are saying that's too much sleep, go back to bed. Okay, you don't know what you're talking about. The only reason why I had a little bit of sleep stress is because I ate late. Fully aware, once again. Okay, went out for a little Valentine's Day food with the girlfriend a little early, just because, you know, she adjusts to the schedule. So I appreciated that. It also meant that I couldn't go live for Coinbase. But hey, sometimes you got to enjoy a late night meal. Went out on the town. It went to a nice restaurant. I actually didn't think the food was all that great, but the view was fantastic. Yeah. If any of the people from Toronto want to guess where I went, I will. I'll see if there's anyone that got it right. Damn, you guys have girlfriends? Dude, it's hard to... in this market, it's hard to get a girlfriend. Like, tech is down. You know, I'd have no portfolio to show off. And it's not like I'm showing up in a nice car. I wouldn't have been able to have a nice portfolio if I have a nice car. So I have to flash the like I print out a sheet and tape it onto my shirt, and it shows the portfolio gains year to date versus the S&P 500. And that's how I get... okay, no spamming, brother. Oh my God, someone ban that guy. Okay. McDonald's, yeah. Knowing this, the only real answer so far is Canoe. Canoe is a very nice restaurant, but we didn't actually end up going there. And not CN Tower either. I guess the view part should give it away, but yeah. Yeah, rip that guy. Okay. The Chase, that's another good guess, but no. Harbor 60, no. No. It was in Toronto, very downtown. Well, not like on Front Street. I saw you last night. You ate a salted frog. Okay. No, sir. Coin stock is on fire. Are we still climbing? Up 18.5. Are we going to see this drop lower or no? You know what I actually did have? Maybe this would give it away. I had like this duck confit pasta thing. Pasta? It's definitely not pasta. And it wasn't that good. I should have just ordered the steak. I'll give you one other hint. It was a steakhouse / sushi spot. Pasta. Okay. Outback Steakhouse. Yeah. Rivian up 30 now, guys. Holy. I have not seen it yet. Fastly still growing. Are like, how green are we right now? On the Qs. Okay, we're not at all-time highs, but maybe Bitcoin is because No, still not above 70. No, Coinbase is just catching a bid. Ding, 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 ding. Nick Hill got it right. Era is where I went. Yeah, you got it right. That was it. It was a pretty cool spot. It was beautiful. The view in the actual place was way better than the food. The food was all right. I said that hours ago. No, you did not. Someone check his account. Check his activity. If you did, I'm sorry. I'll send you a gift card. You can go check it out. Dinner on me if he said it. Actually, I don't think they do gift cards. Scroll up, brother. I don't need to scroll up. I can check your account. You said Harriet Rooftop. Is that the same thing? I don't think that's the same thing. Okay. Stolen valor, yeah. Yeah, you can eat at Subway. Okay. What did I miss? Not much. It's a Friday, guys. This is always the lowest or the slowest news day, because at least Monday, you have the weekend of information to go through. Let's see. Where am I looking? Media could be more capital intensive to keep up with AI competition. Media could be more intensive to keep up with AI competition. How does that make sense? Let's understand that. Where was the F1? There was an F1 shot recreated for 9 cents. I saw this. It was like a fun little X post. So I guess the most expensive shot that they did in F1 involved, the F1 cars, and then also this pretty amazing drone shot. And then they recreated it using artificial intelligence here, which just goes to show you how things are going to change, in my opinion, in the media space. So watch it come in. Look at that. Flying in. See the cat driving super fast. Beautiful. I don't know, man. I think for some of those, like why spend hundreds and hundreds of thousands of dollars to get a single shot whenever you can just prompt it? The F1 looks way better. I mean, you're probably right now, but you probably won't be right 2 years from now. But let's go ahead and see, because I've always questioned that, how things are going to change in the media landscape. Let's have a listen.
And Stephen Cahall, he's senior analyst at Wells Fargo Securities. Stephen, what do you make of the video? Welcome.
Yeah, I mean, first off, credit where credit is due. That taking what the last guest said, these things are moving very fast, and the accuracy, the sophistication, there's no doubt that is there. And oftentimes, I think the market gets things directionally right, but off by orders of magnitude. This is going to create a lot of concerns about the barriers to content creation, because you saw how good it looked in that clip you showed.
I'm always a little slow on these narratives until I finally get it 6 months later. So but I look at the video and I go, I'm not connecting the dots back to selling off some of these media giants. I mean, there are, Hollywood is up in arms about kind of protections against their own images. So I guess if you wanted to say you can create an AI movie based on characters whose property is not intellectually protected, okay, fine. You know what I mean? Just like break this down for me.
Yeah, I mean, I think first it's good to look back at some of the history of the sector, over the last 10 or 15 years. YouTube is now the largest television platform in the US in terms of Americans' time spent. They spend more time watching not just YouTube, but YouTube on a television than they do any other, sort of media platform. And 10 years ago, that was effectively zero. So that has given birth to a new type of creator and a new type of content, and some of that content has resonated. And so whether or not this gives birth to, things that are in intellectual property, copyrighted, et cetera, that's probably not the point. It's probably more that there's going to be a lot of stuff out there, and does it create some engagement risk for big media companies that didn't exist before? The second example I just point out is that Netflix, Amazon Prime, they really changed the way media companies thought about the importance of original content, original series in particular. And we look at media today, and every company is a streaming company. There is a lot more capital deployed into content than there was in the sort of decades prior to streaming. So it could even just be that it becomes a more capital-intensive industry to keep up with some of that competition.
Netflix shares are now below 77, although they're on a slight bounce today. So should they not buy Warner Brothers Discovery on this idea? Forget whatever you thought about the deal a couple months ago. With these tools now, and what you're saying, which is that users are going to be generating the next wave of video content, is the legacy stuff really that valuable?
I'm afraid I'm a little limited in what I can say on Netflix and Warner Brothers due to some activities of Wells Fargo's and my suspended coverage. However, what I did write in a note yesterday that's maybe to the point of the question is, as much as I don't want to have my head in the sand about these emerging technologies, I would also point out that what really makes content hard is stories, story arcs, writers, directors, real life people acting those out that makes them compelling. You look at what Lionsgate just sold Mad Men to HBO. You look at a lot of the historical content and how relevant it is today and how much engagement it gets today. And you think about the content that's going to be really powerful and compelling in the zeitgeist, moving forward, the things that we're all talking about, that we're seeing, our friends, parents, kids are seeing, et cetera. That stuff is really hard to make. Every Hollywood studio wished that everything they made was great. A lot of it isn't, because it is so hard. And I'm not sure that visualization is a replacement for good stories or originality.
Although, thank you for kind of teasing this out piece by piece, because I would look at user-generated content and say, it turns out a lot of people are really good storytellers, and it's almost a VC model where if you get enough user-generated content, you're going to come across a decent number of good stories in there. I take it, but let me get to the opportunities, because I know that people are eager to hear from you on this. So, and you say what Disney's doing is the right move for what's going on here, to emphasize parks and experiences. So I think, correct me if I'm wrong, that's one of your big opportunities. So with Spotify, maybe that's because they can benefit from AI-generated content. And Fox, why those three?
Yeah, just to treat them individually. So a point we made Disney is that 70% of their operating profit comes from their experiences division and their sports division, which is ESPN. People still want to go do things. And I think the more we get flooded with content, some of which is good, a lot of which is not going to be good at all, I think that only increases the premium of experiences. And sports is another one where we're of course not on the field, but the way we feel watching sports is because it is live, it is unpredictable, and it's not created by anyone, and that unpredictability is what drives all of that excitement.
Yeah.
So for Disney, that is the vast majority of its income comes from those two things. Fox's two assets are essentially the Fox Broadcast Network, which is sports and
All right, I'm kind of done on that. Plus, I have to wrap it up. What I will say on this is that even if we just look at it for specific scenes like that F1 scene or some Michael Bay-esque massive explosions or something like this, that even if you could cut out some of those high budget just scenes in a movie with AI, or at least AI in parts. Obviously, like CGI and stuff like this already plays a big part, but like just helping that look slightly better, I think is going to be a big, part in this. Help speed up production for movies, help save on costs, maybe allow for more of that budget to go towards marketing. And that's all very exciting. So I'm excited for the media landscape, but I'm not looking necessarily to bet on Netflix because I'm a YouTube all-inner. Ladies and gentlemen, I most likely will do something tonight. I like doing these sort of like tech frenzies, at least maybe once a week, where I can just come on and talk about how I feel about the overall market, what I'm investing in and stuff like this. So maybe we can do a little bit of that. Until next time, thank you all so much for watching. Really do appreciate your time. But bye for now.